Washington Journal continues.
Ryan Avon is the online economics editor with The Economist, here to talk about that headline that China is becoming or has become the second largest economy in the world, surpassing Japan. That was the news yesterday coming out from the latest statistics. Let me just put up on the screen for our viewers second quarter GDP, because that's what everybody was looking at yesterday. In the United States, second quarter GDP, 3.5 trillion. China, 1.337 trillion, and Japan, 1.288 trillion. What do those figures mean, and why do they matter?
Well, I think what we see is a culmination of a long process of growth for China that's really been good for Chinese people, but it's also sort of created some tensions in the world. That's finally led to the point where they've surpassed Japan as the second largest economy in the world. They've sort of been going back and forth the last few quarters, but economists think that they've finally cemented their place there. And it tells us a couple things. I mean, it tells us that at this time where the global recovery is still pretty uncertain, that China is really one of the bright spots, and their growth has meant a lot in terms of maintaining the global recovery. It also tells us a little bit about Japan in the sense that one of the reasons they've fallen back is that they've done very poorly in the second quarter. Their economy seems to have slowed down pretty sharply. And that's obviously a concern for people here in the U.S. because we've seen a lot of signs that our economy is slowing sharply as well, and also signs that we may face sort of the long-term deflation and stagnation that Japan has seen. And so there's a worry there that we may see more of ourselves in Japan than in China.
So going back to China, though, and this becoming possibly the second largest economy, what does that mean specifically for consumers, American consumers?
Well, I think what it will eventually mean is that China is going to be a very large market for consumers. Rich nations want to buy a lot of American products, see American films, use iPods, things like that. And so over the long term, it really is something to be happy about. I think one of the concerns right now is that at the moment, we buy more from China than they buy from us. We have a large trade deficit with them. And there's a sense that with the economy weak, that means that their growth is sort of coming at our expense. And that's not necessarily true. I mean, there are a lot of factors that lead to those gaps. But that's certainly the perception, and that I think creates a lot of tensions that we see in Washington, and could conceivably lead to some trade war issues that would ultimately be bad for consumers, raise prices and things like that.
Another part of the story that came out yesterday about China, in the stories, it was often noted about per capita gross domestic product for these countries, if you break it down. In the United States, per capita, it's 46,000, which means per person, gross domestic product. In Japan, 32,600, and in China, around 6,600.
That's right.
So what does that say?
Well, I think it gives us a sense of perspective about what Chinese growth has meant and what it's going to mean for the future. I mean, after 30 years of growth, they've reached a point where, as you say, they now have sort of $6,600 in output per person compared to 4,600 or 46,000, excuse me, in the U.S. And essentially what that means is they're much poorer than us. They have a large economy, but a lot of that is due to the fact they have so many people. And so they have a long way to go to catch up. And I think it's often lost in the conversation that China really is a relatively poor country, and that's going to affect their outlook towards growth and the need to maintain growth. And it also, I think, should give us a sense of confidence in the fact that we don't need to worry necessarily as much as people often do about China's rise.
And some noted in the stories yesterday that I saw that this idea that China could catch us is not exactly realistic. And some put the figure at about 2030, the year 2030, when China could conceivably catch up to the United States.
They would have to maintain very rapid growth rates for the next 15 to 20 years. And that's difficult to do. I mean, obviously, we've seen how hard it is just to maintain 2-3% growth for the U.S. There are a lot of ups and downs. And then the other thing is that China's authoritarian government sort of adds a different variable there. It's not clear whether they're going to maintain the institutions they have now, whether there's going to be trouble as they struggle to move towards a democracy. And so it's going to be a challenge for them to maintain these rapid growth rates.
They have had rapid growth rate over the last decade or so, around 10% year after year. Is that not?
That's true. But then one of the other issues that goes along with that is that growth has sort of been built on this relationship with the U.S., where U.S. consumers are taking on a lot of debt to buy a lot of consumer goods, and there's sort of a mutual dependence there between the U.S. and China. And obviously, there's the sense that U.S. consumers can't continue to do that we need to borrow less, save more, and that's going to affect the ability of China to rely on export-dependent growth.